Hello, everybody. I'm James Leichter from Aptora. Thank you for being here today. We are going to talk about taxes. How fun is that, right? I really appreciate the great turnout considering we're talking about taxes, but I guess I shouldn't be surprised because we all pay taxes and we don't want to pay taxes when we don't have to. In fact, it's good to remember that it is illegal to evade, it is legal to avoid. And you should do everything you can to avoid. So there's a difference between avoiding taxes and evading taxes. And we're going to talk today about evading taxes. No, I meant avoiding taxes. That's what we're going to talk about. I never talk about evading taxes. That would be terrible. We are going to focus on and I almost hate to say the name, the one big, beautiful bill, right? Tax Act, I'll call it. Maybe call it OBA or something for short, but we're going to talk about that bill, specifically how it affects business owners. So that's the agenda today. I'm going to start out by talking about the most significant parts of the bill as they apply to most of you, and then I'll talk about some of the minutia. As always, I invite your questions live during the presentation, and if you're watching the recording of this, please leave your comments, questions below, and I will do my best to make sure they are answered. And as always, let us know what you'd like to see in the future. Okay, let's get started. First things first, how much is this going to save you? That was the first thing that I really wanted to answer in this slide is what can I expect this tax bill to do to my tax burden? And here's pretty much how it breaks out. The bottom 20% of taxpayers are those making up to $34,600. They should expect a tax savings of $150. The second quintile is those of you making $34,601 up to $66,800. You should expect a savings of about $750. Now, by the way, how did I come up with this? None of this is personal. I'm going to leave personal opinions out of this thing. The only personal opinion I have is it's a weird name for an act. Okay, but that's it. That's the only personal opinion I will have on this. I will just present you with the numbers. These are according to my calculations, and also I sourced this particular information from fastcompany.com. Those of you making 66,801 to 119,200 should see a savings of approximately $1,780. In the 119,201 to 217 income range, the savings should be $34,060. The top 20% of all taxpayers are those making $217,101 and higher. They should see a tax break of $12,540. The top 1%, a savings of $75,410, and those making over $5.184 million, that's the top 1/10 of 1% of taxpayers. They should see a tax savings of a nice $286,440. So there is a little bit in here for everybody. Everybody, for the most part, everybody saves money on their federal income taxes, some more than others, and it also depends on what deductions you are able to take advantage of. And that's what I want to talk about next, the various deductions that are now available or have been modified. There's a few terms to know, I think, before we get going any further. And I won't get into these too much, but we're going to talk about, and you're going to read, adjusted gross income. And you're going to see the term modified adjusted gross income. And you're going to see qualified business income and pass-through income. Adjusted gross income is basically your wages, interest, dividends, interest income, minus certain things like retirement contributions, like IRAs, student loan interest, health savings, account contributions, and educator expenses. Your modified adjusted gross income starts with AGI and goes from there. It adds back certain deductions to determine your eligibility on certain tax deductions. If it seems kind of complicated, it can be, and that's why there's a whole industry that does tax return preparation, which I'll plug My company, RA Tax and Accounting, we specialize in income tax preparation, accounting, and bookkeeping services for small business companies. I mention them mainly just to remind you there's a whole industry preparing income tax returns because it's so darn complicated. Qualified business income is an important term to know. That is basically the net income on a qualified business. And you'll see that throughout the tax code and the materials we're going to be talking about today. I'll spend more time talking about qualified business income, QBI, because I think it's one of the very best deductions available for almost all of you. Pass-through income is another term to know. Pass-through income is easy. It's just income that passed through your non-C Corp company into your own personal tax return. If you have a sole proprietorship, a partnership, an S Corp, an LLC, those businesses have an income, hopefully, and that income is not paid by that entity. It passes through to your tax return and the owner's tax returns, and all of you pay the taxes on that income. So that's what's meant by pass-through income. All right, let's get into it. First thing I want to talk about are C corporations, because most of you don't have C corporations. I know some of you do, but most of you don't. There is not a lot in this bill that changes the C Corp tax burden, but it's a big one. It's a significant one. The tax rate for C Corps used to be as high as 35%. It was reduced to 21% starting in the 2018 tax year. That was set to expire, but it is permanent now. That will not expire. So it's not new, but instead of expiring, it has been made permanent. It hasn't been continued or extended. It is now permanent. So that is a huge tax savings. If you are a C Corp, you are going from 35% to 21%. And as you might know, or you might be curious, the C Corp pays taxes on that income. If that income is given to the owners through a dividend, then the owners pay income on those dividends. So they are taxed twice. May not seem like a great idea, but at a 21% tax rate, not 35, some of you might find it appropriate to be a C Corp. But for the most part, most of you shouldn't be a C Corp. There's no advantage to it. But of course, if you have any doubts or you want to know more, please talk to a competent accountant about that and put that to rest in your mind. But most of you are probably good not being C corporations. That's the big one. That's huge, and that's giant. I mean, when you're a large corporation, that is a significant savings to that corporation. Let's talk about corporate versus pass-through. As I touched on earlier, it's important to remember that a C corporation pays 21% now at a federal level. So that's their tax rate at a federal level. Dividends, if there are any, go out to the owners, and the owners are responsible for reporting that as income and paying taxes on it. Pass-through income, again, for non-C Corps, pass-through income passes through the company onto your tax return, and you pay taxes on it. We want to focus on reducing the tax burden on pass-through income, and that's the last I will say about C Corps. Unless you have questions, we will be talking about pass-through income and also personal deductions that have nothing to do with a business necessarily. Let's talk about the big one. If you're not a C Corp, this is it. This is the big one for you. This is the most significant change for the rest of us who are not receiving dividend income through our C Corp or running a C Corp. It is called the Qualified Business Income Reduction. You can take a 20% deduction in your company's net profit before it passes through to your tax return. And that's pretty well it. There's some fine print, there's some There's some caveats to this, but for the most part, if your company has a net profit, you're non-C Corp. I'm going to quit saying non-C, okay? So for now on, I'm not talking about C's. If your company has a $100,000 net profit, this will reduce it by 20%. So what happens is $80,000 passes through and goes to your personal tax return. But you still have all the normal deductions that have applied before. This is just a gimme. It's just a freebie. It's like 20%. We're going to cut your pass-through income by 20% because we love you. Boom, there it is. So instead of $100,000 passing through, $80,000 passes through, and you have many of the same deductions that you can still apply in addition to that gimme. There are some thresholds, as they're called. It's $75,000 is the max for single filers, and $150,000 is the max for joint filers. And there is a $400 minimum deduction. So if you have no deduction that applies to you, at least you get a $400 deduction that wasn't there before. To get that $400 deduction, to get any deduction for that matter, you have to have at least $1,000 in QBI, qualified business income, and you must actively participate in the business. You can't be a silent owner. Remember, your tax people should know all this, should figure all this out. Hopefully, you don't have to tell them about these things. They will know and apply these as appropriate when they are doing your tax return. Remember, it's not a deduction on your business return. It reduces your personal taxable income first, and then you can apply other deductions as appropriate. So it is literally just a cut my income, cut my taxable pass-through income by 20% freebie. All right, so that's a good one.
Hey, James.
Yes.
Will they be able to download this?
Yes, question was, will you be able to download this? And for just $4.99, no, I'm kidding. Would that be deductible, though? We'll make it available for a download after this. We would just have to put on, I just want to put on a header and a footer. I left them off so it looked better. So we'll put a header and a footer on here and make it a download. Okay, where was I? Here's a real world example of how this qualified business income can work. Your business makes $200,000 in net profit, as an example. You pay yourself $70,000 in W-2 wages. So your company pays you $70,000 in W-2 wages, and after that has a net income of $200,000. The remaining $130,000 flows through to your tax return and is eligible for a 20% QBI reduction. Again, just across the board, boom, 20% off. So that reduces your taxable income by $26,000. So if your company makes $200,000 after paying you $70,000, there's a $26,000 savings right there. And again, there's no catch. You still have all the normal deductions that might apply to you. That's just a freebie, 20% off across the board. The next big one is the bonus depreciation. This may not apply to you today. It might apply to you some other tax year. It may never apply to you, but if this applies to you, it is a great thing. Honestly, it really applies mostly to high income earners or those who are making large CapEx, capital expenditures. If I throw out acronyms and don't explain them, shame on me. So it could be a high income earner, a wealthy person, but really it's someone who's making a large capital expenditure. And I'll show you why in a minute. So as of January 19th, 2025, machinery, vehicles, equipment with a 20-year recovery now enjoy a 100% bonus depreciation. That's been permanently reinstated. That was part of the 2017 stimulus package that went into effect in the tax year of 2018. It was set to expire. It's now permanent. So corporations, wealthy business owners can reduce their taxes after investing large sums of money in equipment, factories, AI infrastructure, buildings, and many other things. Here's a real world example of how it would work. Let's say that you're making a large capital investment, and maybe that's in a building, like a building you might buy for your business. Maybe it's a data center if you're doing that, but it's just a large capital investment of many different kinds, not every kind, but many different kinds. And let's say it's for the year 2025. Let's say that the capital purchase is $10 million. So you're spending $10 million on this building, this equipment, whatever. Your taxable income before depreciation is $12 million in this example. So you made $12 million. I said for wealthy people, right? So let's say you have income of $12 million and you're investing $10 million. If you're not a big shot like that, just take a 0 or 2 off of it. Like for me, I'd have to take, 6 zeros off of it. I made $10. I made $12. I'm investing $10. Let's say that, again, you made $12 million. You're investing $10 million in qualified equipment. You have a marginal federal tax rate, because you're filthy stinking rich, of 37%. So your potential federal tax is $4.44 million. But wait, that's for poor people to pay. Under this Section 179 deduction, which is what you would have probably taken advantage of before this came along, you could reduce your federal tax down to $3.7 million, and it could give you a first-year tax savings of about $740,000. So under Section 179, which I think many of you are familiar with, this is what you would have used before, you had limits. You could only go up so high under Section 179. So you could end up saving quite a bit, $740,000. So rather than pay the $4.44 million in taxes, you could pay $3.7 million because you've cut $740,000 using Section 179 depreciation. But under the 2025 bill, you have your permanent 100% bonus deduction, and here's how it would work. All $10 million is fully deductible immediately as bonus depreciation. There are no maximums like with Section 179. You're not using makers. You're not depreciating it under makers. You can deduct the entire amount. The taxable income then drops from $12 million, rather than you making $12 million, you're making $2 million for tax purposes. Now you still made the $12 million bucks. You've still got that in your pocket. But for income tax purposes, you didn't do so well. You're making $2 million. So your federal tax savings will be $3.7 million. That is a big one. Again, I'm using an example with millions of dollars. It could be a smaller example for you, but that is the next big thing if you can take advantage of it. There's some other miscellaneous items in there. And by the way, I'm not covering the entire bill. I'm just covering things that I think apply to most of us as business people and also to the individual taxpayer, which I'll get to. There's been an extended deduction for work vehicles related to clean hybrid vehicles. So certain vehicle types apply, but you don't even have to qualify for the Section 179 depreciation. On top of that, if you qualify for this, you can get additional tax deductions. There are some EPA certifications and guidelines, thresholds that haven't been published yet. So this is about all I can say on it. It's in the tax bill, but what hasn't been decided is what actually defines a qualified purchase. So we don't know yet, but it is related to clean hybrid technology. Most people won't be able to take advantage of this And they probably don't even need this because they're probably expensing these things anyway. But when it comes to doing research and experimental work, those expenditures are supposed to be capitalized. Well, you can, in many cases now, expense R&D expenses immediately. So if you were doing R&D to develop a new division within your company, or you were trying to patent something, or you were trying to develop new installation techniques, those things normally have to be capitalized. You can't just call those a deductible expense. Most of you probably don't capitalize those, and you don't have a lot of that type of thing going on in your company. But if you do, then now you can benefit from immediately expensing those. So that might mean that you can write off certain things like tools, trucks, and software that you couldn't before. Again, that probably doesn't apply to you because you are likely just calling those G&A or everyday expenses and deducting them already. There have been a lot of changes for the individual taxpayer. Now, for most of us, we are taxpayers, right? And this all applies to us because this can reduce our pass-through income, really our total income. You have your pass-through income, you have your W-2 income, put it all together, you're paying taxes on it. So the rest of this will help all of us. There is a brand new federal deduction that allows individuals to exclude up to $12,500 of overtime income. That's $25,000 for joint filers. So that way, if you have overtime income, which wouldn't apply to most owners can't pay themselves overtime. They don't qualify under the Fair Labor Standard Act. But some of you would if you have a small company. But your employees certainly can benefit from this. $12,500 of overtime income is excluded, $25,000 for joint filers. It does phase out at $150,000 and $300,000 in income respectively, and the phase out is $100 per thousand in excess income. So really, it applies to those making up to $150,000. But again, even though you might make $150,000, it only applies to up to $12,500 in overtime. So it can't be like you made $75,000 and you made $75,000 more in overtime and all of that's exempt. Only $12,500 is exempt, and your FICA and Social Security is not exempt. So you're still paying FICA, Medicare, Social Security. You're still paying what's called employment taxes. We collectively call that employment taxes. You're still paying FICA, Medicare, Social Security, and the company is still matching that. That does not go away. So the impact isn't as significant as it would seem, but anyway, that is available. There is an increase, this is a big one, there's an increase in your standard deduction effective 2025 and going forward. And this is also, by the way, indexed to inflation. You have a standard deduction of $15,750 for single filers. So that means that your first $15,750 or $31,500 is tax-free. You don't pay federal income taxes on that. So that's your standard deduction. If you do not itemize, you take your standard deduction, and that's been increased substantially. Another thing, as I mentioned, it's indexed to inflation, meaning that next year they will look at the inflation rate and increase it depending on the inflation rate. That's nice too because it has not been indexed. It had to be acted upon by our government to increase that, and now it increases automatically. So that nearly doubles the standard deduction that you had the prior year. That's a nice one. There are several miscellaneous deductions that have been nixed. That's the downside to it. They increased the personal deduction, but they did get rid of some miscellaneous deductions. like for example, unreimbursed employee expenses, tax preparation fees, certain educational expenses for educators are exempted. So teachers, like my daughter, there's exemptions, so she still gets to take a deduction on some of those miscellaneous expenses. But for the most part, most of you will benefit from that, even though some of those small deductions were eliminated. There are SALT cap modifications. So what the heck is SALT? It's sodium chloride, right? No, in this case, it's state and local tax. So let's say you live in New York. One of the things taxpayers complain about living in New York, among some other states, is they pay a ton of money in state tax. And they only get to deduct part of that as an expense when they're reporting their federal tax. This increases the amount that they can deduct substantially. It wasn't as much as many people would like, but it did go up to $40,000 through 2029 for those with adjusted gross income. Here comes that term we talked about earlier, that are equal to or less than 500,000 for joint filers. And then it phases down, meaning when you make more than that, the benefit starts coming down. But that's a pretty significant increase. But it ends in 2029 and it resets itself to $10,000 afterward. So if you are a high income earner, that didn't help you that much. It'll help you a little bit, well, maybe quite a bit through 2029, but when it goes to $10,000, that will be a real bummer for those making a lot of money. But that is a state issue. There is an expansion in dependent care. So if you have dependent care, you can now deduct more than you used to be able to deduct before. And that would be things like daycare, after school programs, things like that. They define those. But for the most part, after school programs, daycare, and by the way, even in many cases, expenses related to getting them to daycare and after school programs and things like that can be deductible. Again, I'm not giving you definitive tax advice, but just don't forget, it isn't necessarily the check you write to the daycare center, but there's some related expenses that can often be deducted as well. But they have increased, and what's great is you don't even have to itemize. And you know, it occurred to me, I should explain, if you don't know it, personal deduction versus itemized. If you don't want to itemize, like fill out a giant list of all of your tax deductions, that's itemizing. If you don't want to do that, you take the personal deduction. If you want to itemize and tell the IRS, here's all the money I spent, this should reduce my taxable income. If you want to do that, you're welcome to, but you don't get the personal deduction. Well, with this one, you don't even have to itemize to get that expense or that deduction, which is pretty cool. There's also a new senior deduction. For those of you who are 65 and older, you get to take a little bit more of a deduction on your retirement income. It's set to expire, I should say, in 2028, so it's temporary. But the new personal deduction is $6,000 for individual and $12,000 for joint filers. So kind of like a personal deduction we talked about earlier, this is just a gimme. This just says, hey, we're going to forget about $6,000 or $12,000 filing joint, and you don't pay taxes on that Social Security retirement income. But again, that does expire in 2028. Those who really benefit, I think, are those making around $75,000 in adjusted gross income individually and $150,000 in joint income. So I think quite a few people will benefit from that. What I recommend you do, though, if you're a small business owner or maybe a retired entrepreneur, you can't be one of those unless you can say the word entrepreneur. So if you're a small business owner or you're maybe a retired or partially retired entrepreneur, or maybe you're thinking about retirement, this is important to you. So you should be estimating your AGI early to see if you qualify for that deduction, and maybe there's something you can do about it before the end of the tax year. And you want to recalculate your expected taxable Social Security benefits using pre and post deduction scenarios. Hopefully, you'll get with your accounting people before the end of the tax year and run through these exercises. You might consider a Roth conversion or maybe a charitable contribution, but you want to take advantage of these through planning, and you've only got a few years to do it. There has been an estate and gift tax freebie included. So if you are going to be receiving an inheritance, or possibly you have family that's going to inherit from you, the living will be thrilled, because there is a permanent exemption set to $15 million for individuals and $30 million for joints, and it's indexed to inflation. So not only is it a permanent $15-30 million respectively freebie, but it's indexed to inflation, and it's effective 2026 onward. So you can inherit $15 million, or you and your wife or husband can inherit $30 million tax-free, and it goes up every year, indexed to inflation. So if you are getting ready to inherit that kind of money, I would like to be your new best friend. What has been eliminated or reduced? So what deductions, I've given you a lot of good news so far. What's been eliminated and or reduced? Well, there's been a lot of miscellaneous itemized deductions that have been eliminated permanently. A few of them are what's called unreimbursed employee expenses, investment fees, tax prep fees, union dues are non-deductible permanently now. There's a few others. Those are the major ones. There's limitations on the lifetime learning credit coordination, as it's called. So you can no longer claim certain things in the same year as other educational credits unless you qualify in certain ways. But bottom line is, I think many of you won't apply to, but those have been reduced or eliminated. There's also been, and this is really important for our industry, and I mainly work with the HVAC, plumbing and electrical industries. This really applies to the HVAC industry especially. Many home energy credits have been reduced or eliminated or repealed. And so this could be the last year you have to talk about savings as a result of these credits to your prospects and your customers. Residential energy credits for solar panels, insulation, doors, windows, geothermal systems, they've been phased out sooner than under the IRA, the Inflation Reduction Act, allowed. And credits for leased solar installations have been eliminated. So if you are leasing people solar installations, they no longer can benefit from that as being a tax deduction. So that can affect our sales. You probably talked about these things during the sales process. You won't be able to just make the most out of it this year, this tax year, because after that, they're eliminated. New domestic content rules disqualify some foreign manufactured systems. So there's a new set of rules based on where it was made or how much of the system was made elsewhere. Too much to get into here, but again, that's going to be affecting, I think, the HVAC industry significantly. That's one of the most important ones to be thinking about. The clean energy credits were reduced, but they weren't completely eliminated. The credits for rooftop solar heat pumps that began on certain dates, often requiring installation before 2025, 26. Again, keep that in mind during your sales process and make the most out of it while you can. There are still some credits available, although they are modified, like the Efficiency Home Improvement Credit and the Business Energy Investment Credit and the Clean Electricity Production Credit. They have been reduced, but at least they are still available. All right, here's some bonus content that I wanted to include. I wanted to make sure you were taking advantage of these things. And I have 3. I could have included a lot more, but I think if I make a big deal out of 10, I'm making a big deal out of none. So I thought I would just point out 3 that I see people often not take advantage of. If you have an S corporation and you provide health insurance to your employees, then of course you can provide health insurance to the owners. And what a lot of owners don't realize, and this applies to owners that have 2% or more ownership in the company, if the business pays their health insurance, those premiums can be added or have to be added to your W-2 as income. But then they can be deducted above the line on your personal tax return. So not to get too much in the weeds here, but as an owner, those deductions come before your taxes, unlike your employees in most cases. But it still applies. The same thing can apply to you. And if your tax people aren't doing this, then you've been missing out on a great thing, because ultimately you still get to take that deduction top of the line. Even though it's on your W-2, it's deducted above the line, meaning before anything else. There's no qualifications or limits or whatever. That gets deducted on your personal return, 1040, line 17. It's often overlooked. I mean, I have seen so many times where people weren't taking advantage of this because they didn't know, and their tax preparer apparently didn't know or didn't check. That also applies to vision, dental, and in most cases disability, not AFLAC, but in most cases disability. Again, talk to your tax people about that, because there's some caveats, but for the most part, it's not just health insurance, it's dental, it's vision, and in many cases, it's disability. Again, if you're an owner, that's been going on your W-2 as income, it should have been. And then you can then take a top of the line reduction in income before there's any tax deductions considered. So by top of the line, what I mean is, if you make $1 and you have a top of the line deduction of 10 cents, then you made 90 cents before we consider any tax deductions, any rules or anything else, any thresholds, any maximums. It comes off the top of the line regardless of your income level. So that's important. That's a big one to take advantage of. You still, by the way, are allowed to take the deduction even if you don't itemize. Even if you don't itemize, you still take that deduction because it's top of the line. It's top of the line deduction. And remember, it does apply to dental, vision, and in many cases disability. Even long-term care policies can usually be wrapped up in the same. This probably doesn't apply to many of you, but if it does, it's one of those things I see that's often overlooked. If you are researching new divisions, new revenue streams, new businesses to get into, that shouldn't be tax deductible. You're not allowed to just write that off. Otherwise, you could just pretend to be investigating all kinds of new revenue streams, fly yourself around the world, buy lots of things. Well, you can't do that. You have to capitalize those things. But now you can deduct a certain amount of that right off the top. And so instead of capitalizing, you can deduct $5,000 of startup expenses and R&D expenses. After that, they have to be capitalized and treated normally like a CapEx expenditure. You don't need, by the way, to be a company. You don't have to have an EIN. You don't have, and EIN means you're a company, right? You don't have to have that to take that deduction. You could be an individual and still get that deduction. Another thing that people don't take advantage of, and I think have a hard time believing it's even real, is the self-rented property deduction. That's the name of it, but really everyone calls it the Augusta rule. And if that word sounds familiar, Augusta, it is in fact named after the golf course, the Augusta Golf Course. And there's an interesting history behind this deduction, but here's how it works. If you personally own a property like a shop, an office, a storage building, and rent it to your business, then you can deduct the full fair market rent from that business. You can report the income on your personal return, but not pay self-employment taxes on it. Even rent your personal residence to the business, and this is the big one. This is really the Augusta rule part of it. You can rent your personal residence, your house, to your business for up to 14 days per year with no tax on the rental income. And your business still takes it as a deduction. So let's say you have a house and you have a business. Your business could then approach you and say, hey, can I rent your house for 2 weeks? Why? Well, it's none of your business. I just want to rent it for 2 weeks. How much? You would rent your home to that business for 2 weeks, and it has to be fair market value. That income does not have to be reported. I mean, you could if you wanted to be nice, but that income doesn't have to be reported on your tax return, and the business still gets the deduction on that. And I think it'd be fun to make a video on that whole topic, the Augusta rule, how that came about, but someone I'm sure already has made a video on it. But that's it. That's the Augusta rule as its nickname. 100% legal. IRS recognized. It's not just some weird thing that you might get away with. It's IRS recognized. It's well known. 100% legal. It can also be used for offsetting meetings, training days, annual planning events. So, what would you rent the house? Why would your business want to rent your house for 14 days? It really doesn't matter. But it can be for a retreat. It can be for one or more meetings. It could be for 14 one-day meetings. Almost any reason applies. Get with your CPA and your tax people no later than November. I would say like next month. I would say more like September, but certainly no later than the beginning of November so that you can start planning your strategy out before it's too late. Being in the tax business like we are, the income tax business like we are, too many people ask us things in January when it's too late. And they want to correct things in January or take advantage of things in January when it's too late. Don't wait. And again, some of these things are expiring this year and certainly are expiring in the next few years. So you want to be thinking about that. If you're close to retirement, these changes might make you retire 3 years early. You might want to retire now rather than wait 3 years, but some of you might want to wait 3 years. Again, this is not the place to make that decision. This is not the video for that. You want to talk to your tax people about that and get it figured out. Remember, rich people, again, it's illegal to evade. It's smart to avoid. Oftentimes, rich people pay a lot less taxes because they just think a lot more about paying taxes because they know how expensive it is and they take advantage of these things. As long as these things are there for you to take advantage of, then to me, you're obligated to do so. Again, you can avoid, just can't evade. Speaking of rich people, while we have 10 more minutes, I want to talk to you about how rich people take advantage of the tax code legally. You might be thinking, well, I've just gone over the highlights of the tax code, the benefits of it. I didn't really see anything in there that's going to help those rich people that much. There were a few things like the C Corp reduction and the QBI would help all of us, and the bonus depreciation. Those things will help high income earners. But how do high income earners really take advantage of the tax system? And why do I bring this up? It's not that I'm making fun of the high income tax earners. We all want to be one, but you might already be one of those. And I thought I would point a few of those out. Number one, they borrow against their wealth. They borrow against their wealth. Wealthy individuals buy appreciating assets like stocks, real estate, businesses, and they don't sell them. They borrow against them. They borrow against them to pay their bills if they have to. They borrow against them to pay off their credit card. They borrow against them to spend money. Hopefully, they borrow against them to buy more assets that appreciate. And they borrow against those. They just keep borrowing against assets so they don't have to pay themselves income, which is taxable. They borrow again to pay their bills. Anything to avoid paying themselves, which is taxable. When you pay yourself money, that's when you get taxed. So what they do is buy assets that hopefully appreciate. They have to for this strategy to work, and they just borrow against those assets over and over. You've probably heard about real estate people doing that. They buy a property, they fix it up, they don't sell it, they borrow against it. They buy another one and they fix it up and they borrow against it. That's leverage, and that can come back to haunt you, right? But if done properly, borrowing against your assets gives you a giant advantage. And whether you like that or not, I'm just pointing out that is some technique that many wealthy people use so they don't have to take an income. And you'd be surprised how many billionaires there are out there that get paid a few $1,000s a year because they live on borrowed money. And by the way, borrowed money has an interest expense, doesn't it? And that interest can be deductible as well. So that's the number one thing that people do, wealthy people do, to get wealthier. Also, when they die, those assets get a step up, big term here, step up in basis. And the people inheriting those properties pay no taxes on capital gains. So let's say that I buy an apartment complex for $10 million, and when I drop dead, it's worth $30 million, and I give it to my kids. That isn't going to happen, kids. I give it to my kids. Well, you would think that they would pay $20 million they would pay taxes on $20 million worth of income because the asset got sold and we are recognizing the appreciation. That value went up. You don't pay taxes on it until you sell the asset, transfer the asset. So you would think in this case, even though there's an inheritance avoidance, you would think that there would be a trigger for a taxable event of $20 million. That's not the case. When they inherit the property, the basis, as it's called, resets. It goes back to the original $10 million, and they do not pay taxes on it. In fact, they don't pay taxes on the $10 million because they can get $15 million or $30 million if married. So that's a huge advantage, is when they die, people can inherit that wealth and they can avoid paying taxes on it in a way I think most people would not even imagine. So that is the number one wealth builder in this country. Take advantage of it if you can. There's the carried interest loophole that I won't talk too much about because it applies mainly to like hedge fund and private equity managers, but they can take a cut of their investor profits, and those are called carried interests. And instead of paying taxes on it like ordinary income, which has a 37% high top rate, it can be treated as a long-term capital gain, which is somewhere between 15 and 20%. Again, doesn't apply to most of us. There's a tax-free step-up in basis at death. That's what I referred to earlier. That's when you can just forget about capital appreciation, where you and I would sell an asset. We would normally pay a tax on the appreciation of that asset, like a stock. When we die and we give that to some lucky person, that basis can be reset. No tax event is triggered. There are Roth IRA backdoor conversions where high income earners who make too much to contribute to a Roth IRA, they can contribute to a non-deductible traditional IRA. Then they can convert it to a Roth IRA which is called the backdoor method, even though it's totally legal. And once inside that Roth, earnings grow tax-free. And distributions are tax-free too. Sound complicated? You don't have to worry about it. Your tax people worry about those things. It's reported that billionaire Peter Thiel, he's one of the founders of PayPal, he grew one of his Roth IRAs to $5 billion. And that's one of the ways he got wealthy. So he grew $5 billion basically tax-free using that technique. Totally legal. Why does it sound unfair? Well, because most of us can't take advantage of it, but it is a real thing. I call it a loophole, but by loophole, I'm not saying that it is illegal or immoral. It just happens to be a loophole because of the steps involved seem a little odd, right? Real estate depreciation and 1031 exchanges, kind of touched on that earlier, but real estate investors can claim non-cash depreciation deductions to reduce taxable income. That can wipe out all of their income. Oh, by the way, I should backtrack and mention something really important. When I mentioned the bonus depreciation, that's where you could write off the CapEx immediately. The new law says that you can create a negative carryover. So in other words, you can lose more money than you made, and that difference can be carried over into other tax years. That's another big difference, and that's why you've heard some people, I won't name names, but they haven't paid taxes in lots of years. Well, that's because they had some big loss and they carried that loss over to the next year, the next year, the next year, the next year. That has been made permanent, so you can take advantage of that. This is very much like that. There's also the ability to set up foundations and something called donor advised funds. So wealthy people can donate appreciated assets to private foundations, and then they don't pay taxes on that appreciated amount because they donated it. But then they get full market value for the deduction. So they get full market value for the deduction, but don't pay taxes on full market value. And that avoids capital gains tax. And they can be the director of those foundations and even employ their family and pay their family to work there. And many people do that. You would think you'd have to be super wealthy to do that. Actually, you don't. All of you could do something very similar to that. And it seems a little crazy, but it's completely illegal. There's also the deferred compensation and offshore reassurance. Many of you have heard about this without knowing the details, but executives defer millions in salary to future years, to future tax years, to lower their current earnings. Then they can use that to own offshore insurance companies and then reinvest that money in policy premiums, which is their own money, to defer taxes even further on their returns. Complicated? Yes. That one, most of us probably won't take advantage of that, but it is legal and people do it all the time. So I wanted to point out just 7 strange things that the tax law allows you to do. Most all of you could do these, but the wealthy people are doing those. And that's why you'll sometimes hear the tax code favors the wealthy. Whether it does or not, I'll let you decide. But I think what they're referring to many times are things like this. So with that in mind, do any of you have any questions about the Act? I'll just call it the Act, the big, beautiful Act. Does anybody have any questions about that, how that applies to you or as a business owner or an individual?
We do have one. It says, regarding overtime income, how will we, the companies, show/keep up with this come time for W-2s?
Good one. All right, so the question was, regarding overtime, how do business owners keep up with overtime record keeping? And let me find that particular page because I made notes on that. The bottom line is the burden's on you to do that. but I have notes on that I should follow. All right. I'm getting close. Overtime. Well, while I'm looking, I'll tell you what it is. You need to just keep being diligent about your current bookkeeping. Most of you probably have accurate enough records as it is. You want to be, if you're not though, you want to be diligent about it. The new W-2, which is yet to be released, to my knowledge, will have a new box on it. And that new box will be a place where the overtime wages that apply will be shown. So in the W-2, there'll be a new box for that. And here are some of the reporting requirements. So employers, I took this out of the act and I read the entire act. My goal was to read 25 pages a day, and I read the entire act, and this is from the act. Employers must report qualified overtime separately on the W-2. There'll be a new box for that. And track premium portion distinctively. So the premium portion has to be tracked distinctively. That's really the burden. So you're tracking all overtime, you probably do now, but you're going to need to track the 12,500 distinctively. For 2025 only, employers can use a reasonable method, as they're calling it, to approximate qualified overtime, because the new box may not be available, and a lot of the rules and other things won't be ready. So they're saying that we can use a reasonable method, which probably suggests that they'll give us a break if we don't get it right. Because of the administrative complexity, the IRS plans to issue more guidance and rules on this to prevent us from making mistakes or abuse. Now, owners paying their own overtime, I touched on that. Most owners aren't going to qualify for this. So just be aware of that. If you're interested in knowing if you can, then look at the Fair Labor Standard Act, and it gives you information about that, but most owners won't qualify for that. So hopefully I've answered that question. If I didn't mention it earlier, and I don't think I did, it's probably obvious, this does not apply to states. So states have their own rules about overtime, and many states, I would imagine, are going to say, no, we're not going to follow that. And there's also overtime rules on working after more than 8 hours a day and so forth. So this only applies to overtime as defined in the Fair Labor Standard Act, and it only applies to the feds, not to states. So use a reasonable method this year and make sure that you can demonstrate all regular time, all overtime, and all overtime up to $12,500 worth, and you should be in good shape. And when the new W-2s come out, software companies will adapt to that, I'm sure, and make it a little bit easier for you.
We did have a follow-up to that previous question. They're asking if there's going to be an update in TOM to generate W-2s with the new format.
Yeah, the question was, will there be an update in TOM to generate W-2s with that new box? And yes, we will. As soon as we find out where that box goes and what the calculation rules are and so forth, then we will be adding that, definitely. Any other questions? All right, my people behind the camera say there were no other questions. Quick reminder about Aptora University, which is coming up fast. If you aren't familiar with Aptora University, please go to aptora.com and check out Aptora U. But we still have seats available. You don't want me sitting there talking to an empty group of chairs, right? So please get your tickets now. Come to Aptora University. We talk about bookkeeping. We talk about accounting in general. And then we talk about doing those things with software. We talk about financial analysis. We talk about writing SOPs, workflows, operation manuals. It's very thorough. They're long days. It's hard. You will be tired. You will be worn out, but we'll also have some fun. We'll go out drinking, eating, and we will learn a lot. So I'd like to see you at Aptora University. Go to aptora.com for all of the details, please. So with that, on behalf of my people behind the camera, Alicia, Will, and others, and the rest of Aptora, we want to thank you for joining us today. Thank you for being part of our family, and I will look forward to seeing you in the next video. I'm James Leichter with Aptora. Goodbye.